My Waymo missed a kid the other day. A beautiful demonstration of autonomous vehicle technology. Driving down the street,
Whoa.
a kid on a skateboard was skateboarding and kind of fell into the street because he hit a rock or something. Kid was wearing a helmet, so he was fine, but he was obviously
Right.
down, and it was in front of my car that was going. My Waymo was in Waymo, and the Waymo, very astutely and correctly, slowed down, stopped, got out of the other lane, drove around the kid, and then kept driving forward. And the kid, obviously got. I looked back and he got up and onto the sidewalk. But yeah,
Yeah.
so yeah, all these videos you see, the videos you see that are circulating online are the ones
Yeah.
of it screwing up because people love to make fun of new technology. You don't see the videos of it doing all the impressive things that I'm seeing it do every single day, or not every single day, but every single week at least. I ride in Waymos all the time. I've never had a bad experience. And in fact, I've had many great experiences. Case in point, the one I just outlined for you. So keep that in mind when you see a video of a Waymo screwing up online. That's once in a blue moon. Um,
Of an
and,
artist
and
fix.
and and that's why the bull thesis on Viking stock dropped like 50% this week on
Yeah.
that data. That's why the bull thesis for them is actually still alive because you know what, they were able to deliver like basically 13% weight loss in 13 weeks. Like no one's doing that. Like you
Right.
clearly have some efficacy magic here. And efficacy magic is always that's the big one, right? Like anybody can make a safe drug, but can you make a drug that actually works? When your company, when your stock becomes a subject of a retail frenzy like this and the retail mob goes after it, the management team has two choices. You can either listen or you can not listen. And if you don't listen, then the retail mob will move on and your company will probably, wither and die by the wayside. But if you listen and you work with the retail mob to potentially drive very innovative solutions, I think the retail mob has some great solutions here, one of which is this AI powered matchmaking thing. Then all of a sudden, hey, maybe we can get some new solutions that really unlock value for Opendoor. And management is listening.
Hello and welcome to another week of Being Exponential with Luke Lango. We're going to discuss the economy, markets, technology, and lifestyle, all from an exponential perspective. I'm your host, Brooke. It is August 19th. Let's dive right in. Okay, Luke, we want to start this episode off with a stock we've talked about already, and I know a lot of our subscribers are curious about, and that's Opendoor. It's
Mm-hmm.
had an amazing rally as of late over the past 2 weeks or so. It's shot up. A lot of other analysts are calling it a 100-bagger. I know you mentioned something along those lines yourself. Now, the question here is this real? Is this something we should really be invested in? Or is it a GameStop-like rally? Is this another meme craze of a stock? We wanted to get your insights, Luke. What do you think?
Here's how I would frame that. The GameStop rally was meteoric, right? It was so big, so fast. A lot of people made a lot of money off of it. And the company was actually able to achieve an elevated permanent valuation, right? Where GameStop stock is now is significantly above where it was before the whole craze. Yes, it's not at the highs that the craze brought it to, but
Of course.
nonetheless, it's achieved a higher, like steady state, if you will, a higher valuation steady state than it had before. That was GameStop, a horrible, horrible business with no real value whatsoever. I mean, I know contrarians like to argue that there is, some growth story there, but I really don't see it. I've never really seen it beyond. It's a decent business, I guess. Open Door is different in the sense that I think Open Door, when you look at some of these threads about it, whether it's on X or whether it's on Reddit or wherever it may be, there is, I think, the same amount of retail energy and enthusiasm behind Open Door right now as there was around GameStop back in 2021. But the difference is that Open Door really has potentially so much more value to be unlocked than GameStop did in 2021. because the open door business model, there is so much value in it. And I know a lot of pretty smart people saw that value several years ago, but the business kind of went off the rails. Obviously, the housing market got completely destroyed by high rates and affordability issues and supply demand mismatches, and it's got really ugly. And it's been a really, I mean, the National Association of Home Builders just came out with their August Home Builder Sentiment Index, and it clocked in at another fresh low. And basically, the housing market is as frozen and as bad as it's ever been, except for the great financial crisis, going back to when data's been started being recorded. So obviously that happened, but it seemed like management also just they continue to marry themselves to this very capital intensive iBuyer business model that was going to work if the market turned around, the housing market turned around, but was never really going to work in a bad housing market. And we saw that in the recent earnings report. We talked about it in this podcast. Hey, look, what do you think of that report? It was ugly. It was miserable. Their recent earnings report was absolutely terrible because the housing market has not yet turned around. And so that core iBuyer business model continues to struggle. But that was never really the bull thesis that a lot of people like me saw in Opendoor stock. It was never, oh, these guys are going to be so great at flipping homes. No, the bull thesis was that they could be an AI powered market maker, right? When you think about uh, markets where there are buyers and sellers of assets, think about like stocks, right? Very, very, very large empires have been made. Think Citadel for market making in those markets. Citadel doesn't flip stocks. They're a market maker for stocks. They provide liquidity into the market using really fast computers, using really advanced algorithms. I want to go and sell a stock like Opendoor. If I want to sell Opendoor stock, most of the time when I go and sell it on Robinhood, I go and sell it on any platform out there. I'm not selling it directly to a buyer. I'm selling it to a market maker like Citadel, who buys that and then almost instantaneously, within nanoseconds, flips it and sells it to somebody that wants to buy the stock, right? So the way stock markets work is it's not me selling to a buyer, it's me selling to a market maker that instantaneously flips it to a potential buyer of that stock. They match supply and demand with liquidity and with algorithms and with computers. Why isn't Opendoor doing that for homes? Like that was always the bull thesis, in my opinion, for what Opendoor could be. The process of buying and selling a home has far, far too many middlemen. Like, why do I need an agent? Why do I need, like, there's so many things in there. There's so many costs and so many fees that make it the most painstaking process on the planet. I've done it multiple times in the last 5 years, and it's always awful. It's never fun. It's never an enjoyable process. Why can't we use technology to streamline that process, to cheapen that process, to accelerate that process, to produce better outcomes for all parties involved in that process? And one way to do that is for Opendoor to become an AI-powered market maker, providing liquidity into the housing market, using their algorithms and their AI and their data to match home sellers with home buyers without ever having to take the asset, the home, on their balance sheet. Here's how that would work. Right now, the current business model of Opendoor, okay? Opendoor says, we're going to buy your house. You go and sell your house to Opendoor. Let's say $500,000. You sell a $500,000 home to Opendoor. They give you cash. Now that home sits on Opendoor's balance sheet. It is an inventory risk. It is a balance sheet risk. And they have to go and flip it. Their money's going to be made in the flip, on the margin on the flip, right? What are they going to mark it up for? They're going to do remodel costs, all that stuff. The point being, they have to have the capital, the $500,000 in the first place, to buy the home. They have to then have that asset sit on their books, and they have to carry that until they're able to find a buyer and then sell it. What they should be doing, and it's a nuance, but it's a nuance that could unlock tens of billions of dollars in valuation for the company, in my opinion, is they should be proactively playing the AI matchmaker, the AI hitch for homes. So I want to sell my home for $500,000. I go to Opendoor. I say, are you willing, what offer are you going to give me? As soon as they get an inquiry from said person, what they should do from me, what they should do is they should have a marketplace of demand of potential buyers. And they should go and try and match it immediately. Use their AI, use their algorithms, use their underlying data, their proprietary data, which is a big moat here, to try and find a buyer proactively for that home. Knowing, okay, we have 100 people in our portfolio of our demand circle on our marketplace that are looking for a $500,000 home in the Phoenix, Arizona area with X, Y, and Z. Oh my God, somebody just inquired about it or just said they want to sell a home of that part. And then they play matchmaker proactively. What that'll allow them to do is the money to buy the home then comes from the actual buyer. It doesn't come from Opendoor. So Opendoor doesn't need the $500,000, which they're getting through a loan and paying interest on, to go and buy that home. The home never sits on Opendoor's balance sheet. It simply flips from seller to buyer with Opendoor facilitating the transaction. So what they should be doing is facilitating transactions as a digital real estate agent, if you will, as a digital platform that can in-house all that transaction stuff, as opposed to actually buying the home, holding it on their balance sheet, and flipping it. And so I think if they do that, then there's a lot of value unlocked to be had. And that's what I've always thought about the business for a while, but unfortunately nobody really cares what I think, right? Management's going to do what management's going to do. But when you get and this is the power of the retail mob. When you get a big enough group of people to put in a large enough amount of money into an equity and it moves that equity. I mean, this stock has been brought back to life because of the retail mob. And I say that endearingly. I don't use retail mob in a negative connotation. I say that endearingly. I think it's a cool word. Like, this mob is powerful. This retail mob has ammunition, they have money, they have enthusiasm, and they are willing to fight for what they think is right for the company. They brought it back to life from 50 cents to what are we at? 3.60 now. They canceled the reverse stock split, which is a death sentence for any company. And they brought the company back to life, and now everybody cares about it. And now they're not forcing their agenda, but they are voicing their opinions. And management, this is the kicker for me. This is why I think this turnaround is the real deal, to answer your question at the top. Management is listening. When your company, when your stock becomes a subject of a retail frenzy like this and the retail mob goes after it, the management team has two choices. You can either listen or you can not listen. And if you don't listen, then the retail mob will move on and your company will probably, wither and die by the wayside. But if you listen and you work with the retail mob to potentially drive very innovative solutions, I think the retail mob has some great solutions here, one of which is this AI-powered matchmaking thing. Then all of a sudden, hey, maybe we can get some new solutions that really unlock value for Opendoor. And management is listening. One of the big requests of the retail mob was to push out CEO Carrie Wheeler, and she has been pushed out. She's resigning, and they're looking for a new CEO. So that is a massive, massive step in the right direction. I think this breakout is a real deal. There's a lot of energy there, and there's also a lot of value there. So it's GameStop. It's the GameStop situation with an actually potentially really valuable AI business. That's a powerful combination. That's why some people are saying it could be a 100-bagger.
Got it, Luke. Okay. So I appreciate your bull thesis there, and that actually makes a lot of sense as Opendoor being the AI market mover. However, the company itself does hinge on the basis that homes are being bought and sold. We know a large swath of the population is what I think they like to call golden handcuffs. You bought a house in 2020, amazing rate, you're never leaving, you're never selling. There are other reports, more people, or I guess less people are moving from state to state every year or at all. The primary reason for moving is you got a new job, and we know jobs growth is going down. So in terms of real estate and people buying homes in general, that seems like it's been a downward trajectory. Do you still think the Opendoor idea is bullish with all of these other things happening in the real estate market?
So let me preface this by saying I think that whatever happens at Opendoor, like the success here, the odds of a truly successful outcome still low. Like it's still a long shot because
Right.
yes, I mean you have this very beleaguered, battened, and bruised iBuyer that needs to fundamentally reinvent itself. That's not going to be easy. That the road ahead there is going to be long and challenging. The odds of success are low, but in the event there is a success, the potential upside is absolutely enormous. Here's why. It kind of speaks to what you just asked. The assumption in this model is that people buy and sell homes. That's a safe assumption. The assumption in the iBuyer model is that home prices go up, right? The iBuyer model only works in a positive HPA environment, home price appreciation. If HPA is running at normal 3 to 4% levels, the iBuyer model works because then I can buy it, on January 1st, 2025, and then sell it on January 1st, 2026 for 4 or 5% more than what I bought it for, just based on natural HPA. And if I do it with algorithms and AI and I can target certain homes and, find value and whatnot, then I can get 10%, whatever, 11%, 12%. I can make that ROI on my money in a positive HPA environment. But in a negative HPA environment, which is what Opendoor has been in, which is what we've been in for the past 2 or 3 years, really, that's where the iBuyer model business does not work. That business model breaks. So by shifting from iBuyer to AI market maker, you shift the underlying assumption that drives the business model from I need positive HPA to I just need people to buy and sell homes. Who cares if home prices go up if you're the matchmaker? You're not holding any inventory. You're not actually buying any inventory. Maybe you come in there as like a buyer of last stop, like if everything else fails, and okay, you got to put in cash. But if they can reduce that and become a really efficient AI matchmaker, they don't need positive HPA. They don't need home prices to go up. They don't need 10% HPA or whatever. They can operate in a negative HPA environment and still be a very profitable, high margin business if they become an AI matchmaker. So that's why that shift is so valuable. You shift the underlying assumption to make it work from something that is hit or miss to something that is absolutely guaranteed. People will buy and sell homes. Maybe prices go up, maybe they go down, maybe you get 5.5 million homes sold a year, maybe you get 3 million homes sold a year. I don't know, but you're going to get homes sold every year. You just are. And so if they get into a business model where that's the only assumption you really need for it to work, then guess what? The business model is going to work. And that's why I think that it's a really positive transition that they need to embark on. Again, I think it's going to be a long haul. There's no such thing as a sure thing with this. This is not for your lunch money. It may not work out. But, I'm just, there's like a feeling inside of me. When I read those Reddit threads, when I read what's going on X, when I see some of the ideas being offered, there are some really smart people offering some really smart ideas. And management is now again showing that they want to listen. They pushed out the CEO. They're open to engaging in conversations. They want to have dialogue. They want to make this work. I don't know. When you have that working in tandem, you have that much energy with the management team that wants to work with the retail mob in a business that, again, has a ton of underlying value. I think they're sitting on a treasure chest of value with the proprietary data in terms of how home transactions work and home prices and everything, that it just feels like there's a real opportunity here. There's a real opportunity. And I get why people are, I guess you would call it FOMOing into the stock.
Got it. Okay. So ideal situation is, maybe one of those imaginers are listening to the Being Exponential podcast and it's a win-win, right?
Well, that's the thing. It's like if they can just become an AI market maker, then they can scale very quickly because they have data on all the markets in which they operate. They don't need to go out and get money. They don't need to get big loans to buy homes. They don't need to have, inventory sitting on their balance sheet. So all of a sudden they become a hyper scalable software business and they can scale very quickly from city to city. So Opendoor, when they first went public via SPAC, I think they were targeting like 4% national market share as an iBuyer. That's hard to get to. But 4% national market share as an AI market maker for homes, that's very doable. That's very achievable. And if you just kind of run the numbers on that, we ran the numbers. We just assumed, okay, we actually assumed 2%. We assume 2% national market share, regular home sales, 5.5 million a year. We assume that they can get 30% margins on their AI market making. They have to become a buyer of last resort in like 50% of their transactions. So we assume some very conservative things here. And even under those very conservative assumptions, assuming a 50% pivot to an AI market making model, we still got to about a $16-17 billion valuation target on it. And I think the stock right now, I'll pull it up over on here. We're at a $2.6 billion market cap, right? So, that's a 7x, 8x from where we currently are, depending on, the stock obviously oscillates a lot every single day. But those are using very, very conservative assumptions. Again, a 2% national market share, 50% market making, 30% margins. Like if you all of a sudden go to 4% market share, 5% market share, and you get to 100% market making, maybe 40% margins, because you get economies of scale kicking in there, then all of a sudden, that's how you get your 100-bagger type outlook. So the pathway, it's visible. There is a visible pathway to massive upside in Opendoor stock with the recent developments. The pathway is littered with a lot of obstacles. It's not just a flat walk, right? It's an uphill battle, but there is a pathway. And I think that pathway is enough to get excited about.
Is there a chance for other companies in the real estate sector, say a Redfin, to take advantage of that, and then they would eat Opendoor's lunch in this?
Yeah, I
Sense?
think therein lies maybe what I would call the biggest risk is Zillow actually would be the biggest risk, right?
Zillow.
Because the key to all of this is going to be Opendoor's proprietary data. But Zillow also has a lot of proprietary data. But Zillow doesn't have proprietary data on like home transactions. They tried the iBuyer stuff. They got in and they got out really, really quickly. So Zillow has a bunch of data on like what homes I may be interested in, what homes I'm scrolling through, what homes I'm looking at, what homes. But like, there's a big difference between. I mean, Zillow's become like a social media app, right? Like 20-year-olds go through, or high schoolers play on Snapchat, 30-year-olds play on Zillow, right? Like it doesn't mean I'm actually buying a home. It just means like it's fun to look at homes and pretend I can afford a $10 million home, right? Like that's kind of like
Exactly. Yeah. You go
it's
on
so
vacation,
so that
scrolling.
data's valuable for some things, but I don't think it's truly valuable for becoming an AI market maker in homes. I think the data that's valuable is not the interest data, but the action data. And that's what Opendoor has. Opendoor has the action data because they facilitated transactions. They were buyers in a lot of transactions. They were sellers in a lot of transactions. They have all of the actual action data. When somebody is really serious about buying a home, puts the money down, the transaction actually happens and it closes. They have that data. Nobody else really has that data at the scale that they do. And so I think that provides a pretty strong competitive moat for them against somebody like Zillow or Redfin doing this. Um, Maybe Compass becomes a little bit of a competitor here, but Compass is all about empowering agents, and Opendoor. At least I think the business model the shift they should make should be about cutting out real estate agents.
Mhm.
Compass won't make the pivot to an AI market maker because it would essentially destroy their core business of empowering agents. Because as an AI market maker, you become the agent, right? So from that perspective, I think they're pretty well insulated from competitive pressures if they successfully execute. It's just the execution part of it is going to be really challenging. It's tough. It's tough.
Got it. Okay. So yeah, with that, Opendoor does have a way to become a 100-bagger, but it is still a relatively risky option. Now, Luke, I do want to move on to our next individual stock story. You called it the convergence of AI and AR/VR. So we're talking about Unity Software, which is a 3D content creation and interactive experience making company. They're usually work in tandem with video game companies to help create those worlds and things of that nature. It's had some massive moves over the past year. It's over 100% up in the past year alone. What do you think of that story, Luke?
Yeah, so I've called Unity in a sleeper AI pick, and I actually really like this one for the next few years. Here's why. The story on Unity, it unfortunately got tossed into the metaverse bucket, right? I mean, if you kind
Right.
of look at the stock chart here, They IPO'd back in, what was it, late 2020, and you can see massive hype in 21, massive hype. Now, this was the era of the metaverse, right? Like that's when Zuckerberg renamed Facebook Meta, and they were building these metaverses, and like everybody, not everybody, but a lot of people thought the metaverse was going to be huge, and Unity got tossed into that bucket because they provide the gaming engine to create metaverse worlds,
Mhm.
more or less. So that's why the stock was hot. But then it collapsed, as you can see, 21, 22, 23, all the way into 24, actually absolutely just got destroyed because, well, the metaverse ended up being a flop, right? I mean, I don't know if Meta even mentions the metaverse anymore on their conference calls. So the metaverse is a complete flop. Unity got thrown by the wayside because it was a metaverse play. But I think it's an AI play. And I think Wall Street is starting to realize that because the gaming engine that is central to Unity software creating metaverse worlds is the same gaming engine that would be central, that will be central, I should say, in creating physical AI experiences. That I'm of the belief that we've talked about this abstinence. I think smartphones are going the way of the dodo. I don't think this is going to be around much longer. These little phones. These were created back in 2000. I mean, at least this version, the iPhone, was created back in 2007 and 2008, right? And before that, when was the first BlackBerry? I don't know. But these are now more than 20 years old, more or less, the concept of a smartphone. They were built for the era of the mobile internet. And the era of the mobile internet required interacting with screens. You needed to text to type. You needed to click on app icons. You needed to scroll on screens. That's what you needed to do to make the mobile internet work, to extract value from the mobile internet. But you don't need those things to extract value from artificial intelligence because AI is ambient. AI is not, you don't have to interact with it through screens. You can, it quietly can sit in a room and observe and be helpful. Think, okay, so Iron Man. Um, hate to bring up science fiction here, but science fiction is becoming reality. So
Exactly.
Iron Man, I bring it up because my 5-year-old daughter and other parents that are watching this, I don't know if this is okay or not, but my 5-year-old daughter is now watching the Marvel movies. I think she's old enough for them. I don't know. We'll find out maybe in 20 years. But we're watching the Marvel movies right now. Iron Man is one of the favorites, obviously, because Iron Man's awesome. And you think about Iron Man, right? Like he has Jarvis, his AI. He's not interacting with his AI through screens. Remember, it's all like holographic stuff, right? He like blows it up and it's like, oh, I'm going to play with it over here and, move this over here and I'm going to throw this on top of that table.
Right.
It's all about integrating holographic experiences with the real world, controlled by, or at least assisted by, some AI assistant, right? Jarvis. That is what we're going towards. That is consumer technology in the AI era. It is holographic projections. It is integrating digital with real. It is overlaying digital experiences on top of real experiences, all of which guided by some personalized AI assistant like Jarvis. This is why I'm so bullish on AI glasses. This is why I'm so bullish on the merging of AI and AR, VR. I'm so bullish on, I think that they're creating like an AI necklace. I think that's what OpenAI is doing. They're still kind of hush hush about what exactly they're trying to create over there, but I think it's an AI necklace. I'm bullish on these experiences because that to me is the future of consumer technology. So I get that is a pretty huge assumption. I totally understand that. Not a lot of people will share it, but I really do believe it.
Got it.
If that is the future, take that assumption as fact, then Unity is going to kick butt, man. Because what is required to make that work? You need to integrate digital worlds with real worlds. Who does that? Unity does that. Unity creates digital worlds. Unity was creating the metaverse. So now they can become the operating system for physical AI devices, much like Microsoft was the operating system for PCs and computers. And then Apple and iOS became the operating system for smartphones. But I think Unity can become the operating system, the OS or physical AI devices, because it's going to require excellent state of the art, top class 3D rendering content engines. And that's exactly what Unity builds. The risk here is going to be in other companies that do that. Unreal is one, obviously. So that's the competitive risk, but I think there's room for a lot of players to operate. Unity is working with Apple. Unity is working with Meta. They're already working with the big dogs. And so, in my view, this is a stock that people forgot about, but maybe they shouldn't have. And now it's making a comeback as a sleeper AI play. And I think it's going to have a lot of success. I think 2026 is going to be a big year for physical AI devices. And I think as we get some breakout physical AI devices, the next iteration of the Meta Ray-Bans, this open AI necklace or whatever it may be, the Johnny Eye thing they're cooking up, you're going to start to see Unity work its way into those ecosystems. And I think you're going to get a massive growth reacceleration here. And I think the stock's going to take off. You look at it right now, we're looking at the chart on the screen over here. This is a big technical breakout, right? I mean, we were languishing for 24 and 25 around these super lows, but now we're really bursting higher. Broke above this major resistance. Now we're going up. This is the next level that we're trying to go for, $43. What's really impressive to me is look at these MAs. 50 really pushing higher, 100 really pushing higher, 200 really pushing higher. Fun fact on this, because the stock had such a brief moment of euphoria and then has been essentially in decline ever since, the 200-day moving average, the slope on the 200-day moving average, which is something we pay close attention to. It's the slope of the long-term price trend. The slope of the 200-day moving average is as positive today as it has ever been for this stock. That tells me something's happening. I would be in on this one. I think it's going to be a big winner in the back half of the year and into 26 as well.
I like it. I really appreciate the perspectives here. So we're kind of leaving the core model of it being a video game company and more so a company that powers the future of our, I guess, not handheld devices. A lot of the big companies, big names have made it pretty clear that they're moving away from that. So that is a very interesting model and obviously would be extremely bullish, right?
Yeah, I would say that the bull thesis shift is the company that was building the metaverse to the company that's building holographic AI displays. Right, like that's how I would view it, because I think holographics are the future. I do think that, again, that Iron Man
Yeah.
Jarvis model, we are 5 years away, less than 5 years away from people having that. I think it'll be expensive as all get out, like $5,000, $10,000 a pop at first, and then costs will come down. But I think we are less than 5 years away from there being glasses like the ones in Iron Man with personal AI like Jarvis that'll cost $5,000 and $10,000. I think we are less than 5 years away from that. If so, then Unity software, I think, has an opportunity to become the operating system for glasses like that, building those holographic displays, overlaying them on the real world, and that'll send this stock back. I mean, the high here was what, 200? I think it goes above 200, because back then the metaverse, not that big. I mean, kind of big, but not that big.
Still
Physical
pretty.
AI. Well, I mean, we were talking about replacing iPhones. Like, we're talking about multi-trillion-dollar addressable market here. So yeah, I think the stock could really be a big time winner. I mean, that's my 2 cents. Again, the big assumption there is that smartphones go the way of the dodo. And that's a massive assumption. And I get it. It's a risky assumption. But it's what I really do believe. And it's what I hope for society. Screens absolutely suck, man. I'm tired of going out to dinner or having dinner at home and having people, they're buried in their screens. It's like, ugh. It's just, we got to get away from that. So anyways, I really believe it will happen, and I hope it does happen.
I hope it does as well. I cannot wait until I can do the Tony Stark thing. I might throw
Yeah, the
some
Tony
maybe,
Stark. Do the
maybe
Tony. We'll call
yeah,
it doing the Tony.
doing the Tony. Yep, perfect. Okay. So moving on to the next individual stock story here. I want to talk about Hesai. They are maybe
Yeah.
the leading LiDAR supplier for the autonomous revolution. This stock is pretty hot right now. So I want to get your take on if it's overvalued or if it's time for Hesai to shine.
Yeah, I mean, so Hesai reported earnings last week. Absolutely fantastic numbers. The big story here is that they won an agreement with, I believe it was Toyota.
Mercedes, I think.
Was it Mercedes? Who was it?
I believe it was Mercedes Benz is that they got the a deal
Whoever the
with.
heck it was. it's
right?
important. No, but no, it's important because it doesn't matter if it's Toyota or
Yeah, yeah,
Mercedes or
yeah.
Ford. It's a non-Chinese OEM. That's massive because for the stock's been on a hot streak for a while, as you can see by this chart, right? Big time rally. But as long as it's been on this rally up until last week, it was a China only story. They supplied LiDAR to a bunch of companies in America, but in terms of OEMs, in terms of actual auto manufacturers, all of their clients were China. They did not have non Chinese auto manufacturers as clients until this most recent one. Again, I don't know if it was Toyota or Mercedes, whoever it was. It's a non Chinese OEM. Massive. Not a China exclusive story anymore. This is an autonomous vehicle story broadly, globally. I think they're the best LiDAR supplier. I think LiDAR is critical to self-driving capability, unlocking self-driving capability. We've talked about that before. No need to
Hmm.
dive into it in this episode. But I think Hesai is well positioned for long-term gains. Technically, it's really not that extended RSI of 66 right now. MACD is not that blown out in a positive direction. The valuation, I think, is super reasonable. This is a massive grower. This is a company that I think has over 20% revenue growth, maybe 30 to 40% profit. I think it's a huge grower. And you look at its valuation and it's only zooming on the 6 month one. It's really only 47 times forward earnings, 35 times forward EBITDA, 5 times forward revenue. I mean, these are pretty cheap multiples for a company that has such robust long-term growth prospects. So no, I don't think it's too late for this one. Instead, I think this one will keep on pushing higher.
Got it. Now, you did mention it is a Chinese company, and the current administration has placed stricter tariffs or wants to place stricter tariffs on China specifically. That's
Mhm.
because they want a more homegrown American industrial manufacturing system. Does that create a potential negative outlook on his side that we should be worried about, or is it just foundation so strong that that's almost negligible?
No, I think that's a risk, but I think what you also have to understand is that Hesai doesn't need Trump.
Right.
The world's biggest auto manufacturers are not in America. And maybe that's what Trump's trying to fix, right? He's trying to fix that. But because of the globalization trend that we've seen in the last several years, several decades, sorry, the biggest auto manufacturers aren't in America. Toyota is not in America. Mercedes is not in America. Audi's not in America. Like, these are not American companies. So Hesai does not need Trump. And on the Trump front, it looks like, I mean, they're working out deals, right? Like Nvidia wasn't
Yeah.
allowed to sell AI chips to China, and now all of a sudden they are. Like they're giving 50% of their sales to the government. So deals are being made. And I think that trade flow will continue between the US and China. And I think there is an opportunity for Hesai to win um, some contracts with some big US car manufacturers. So yeah, that's where I stand on that. I just don't think they don't need the U.S. But if they get the U.S., that's just another vertical for growth.
Definitely. Yeah, and autonomous is well underway. We got Waymo really popping up everywhere. So, I mean, this guy's got a long runway, right?
My Waymo missed a kid the other day. Beautiful, I mean, a beautiful demonstration of autonomous vehicle technology. Driving down the street,
Whoa.
a kid on a skateboard was skateboarding and kind of fell into the street because he hit a rock or something. Kid was wearing a helmet, so he was fine, but he was obviously
Right.
down, and it was in front of my car that was going. My Waymo was in Waymo, and the Waymo, I mean, very astutely and correctly slowed down, stopped, got out into the other lane, drove around the kid, and then kept driving forward. And the kid, obviously got. I looked back and he got up and onto the sidewalk. But yeah,
Yeah.
so yeah, all these videos you see, the videos you see that are circulating online are the ones
Yeah.
of it screwing up because people love to make fun of new technology. You don't see the videos of it doing all the impressive things that I'm seeing it do every single day, or not every single day, but every single week at least. I ride in Waymos all the time. I've never had a bad experience. And in fact, I've had many great experiences. Case in point, the one I just outlined for you. So keep that in mind when you see a video of a Waymo screwing up online. That's once in a blue moon. Um, they're the
That
by and
that's
large,
pretty
these things are
impressive.
very effective.
Yeah, definitely. It's for me it's the Waymo kind of maneuvering out of the way and not just stopping there until the impediment was gone. That's pretty nuts.
Well, yeah, because I mean, it was a busy street, and there were other cars on the left lane, right? We're in the right lane, and so it waited, until there was an opening in the left lane because the cars are going by, and then it worked around it. The Waymos that I've been in have worked around construction and stuff as well here too. So there's again, I've never had a bad experience, and I've probably done close to 100 rides in Waymos. I've never had a bad experience, and it's why I'm a huge believer in autonomous vehicle technology, and why I'm a huge believer in stocks like Hesai.
Definitely. Yeah, perfect example there. I couldn't think of anything better. So now I want to revisit a topic we talked about last week, and that is the healthcare big three. We kind of called them something akin to the 2008 episode for healthcare stocks. However, a big deal was made over the past week. Warren Buffett bought, I believe, 1.6 billion shares in United Health Group. And that has been a positive tailwind for that company. I know that was the one where you said it had the most murky outlook out of the three. And
Mm-hmm.
then we got other cases. I believe Eli Lilly has made deals, dropped the prices on some of their GLP semaglutide drugs. So now, what do you think is the outlook with the Warren Buffett deal, with the current climate? And what would you say about throwing hims and hers into that mix of healthcare stocks, Luke?
Yeah, I mean, I like the healthcare sector right now. I do think it's a 2008 moment for healthcare stocks. I do think it's a buy the dip moment. I think in a year, a lot of these stocks could be up more than 100% from where they currently are. Buffett bought for a reason. He's the best investor in the world for a reason. Okay, so you got to listen to that. But when it comes to identifying which stocks in this 2008 healthcare moment to capitalize on, which ones to buy, which ones to forget
Mhm.
about, I think I definitely have favorites. And I definitely have ones I don't like so much. Funnily enough, the one that Buffett bought is one that I don't like so much. I don't really like United Health here a lot. I get why Buffett bought. I get why the retail crowd's going after it. I get why it could, maybe double from here over the next year. I get the bull thesis, but it's just not for me. One, I don't like the DOJ involvement. I think
Yeah.
that's really scary. You don't know how that's going to play out. You don't want to mess with the government regardless of who you are. So I don't like that. But two, I just don't see the pathway forward for a lot of upside. When I look at UNH, like look at this. Here's its valuation chart. It's trading at 17.6 times forward earnings. Its 5-year average is 19.1 times. So it is already, like the valuation multiple is already essentially fully reverted to 5-year norms. It's only 8% below. So let's say the way I like to look at it, right? When you look at a stock price, the stock price equals the P multiple times EPS. So if you want stock price growth, it either has to come from multiple expansion or EPS growth. Okay, so let's say you get some multiple expansion here. It goes back to that 5-year average. You get 8% upside on the multiple. Well, when you look at earnings, you got, sorry, trying to click over here if it ever loads. Well, you have 9% growth next year on EPS, and you have 17% growth the year after that on EPS. So what in total you're looking at maybe 25-30% EPS growth, and then you throw in that over the next 2 years, and then you throw in this 8% multiple expansion. So maybe you get 40 to 50% upside on UNH. I mean, that sounds good, right? But that's in a bullish scenario. That's in a scenario where valuation fully reverts to 5-year norms and EPS does rise dramatically over the next 2 to 3 years. Even in that like super bullish scenario, I'm really only getting to like 40 to 50% upside potential on the stock. To me, that's not enough upside potential. That's not enough gusto for me to be like, you know what, screw the DOJ investigation. This one's too cheap. I got to buy it. I'm not there with UNH. There are still a lot of risks, and if I'm only getting compensated for 50% upside, maybe on the stock for all those risks, I don't think it's worth it. That's my 2 cents at least. That's why it's one of my least favorite in the 2008 healthcare moment kind of genre or theme. One of my more favorites, one of my top dogs, I think, is Novo. You,
Interesting.
you, you, you look at Novo, 13.3 times forward earnings. 5-year average is 28 times, 27.8 times. So it's 52% below its normal valuation. So on valuation multiple expansion alone, again, the assumption in UNH was we get back to a 5-year normal valuation. You put that assumption into this model and you're getting 50% upside in multiple expansion alone, not even looking at the EPS growth side of things. But if you do look at the EPS growth side of things, you go over and look at the model on Novo. Pulling it up right now. Let's get this into USD because who wants to price it in a foreign currency? Come on, come on, come on. Boom. All right. So you're looking at EPS growth here on Novo, and you're looking at, okay, 6% next year, 10% the year after that, 14% the year after that. So next 2 years, let's call it 16, maybe like 20%. So you get 20% on the growth, you get 50% on the multiple expansion, actually 100% on the multiple expansion because going from 13 to 27, remember, is 52% below, but that's a double. So you get 100% there, and then you get what, 20% here on EPS. All of a sudden you're looking at a potential 120% upside on Novo. Like, that is enough for me to get involved with stock, especially since I don't view the risks as that big. I mean, so what if they're losing some share on the injectable? Their oral drug is best in class. We just got results today from Viking Therapeutics. Not very good. Not very tolerable oral weight loss pill. We already had Eli Lilly's. Decent, but not as good as Novo. So Novo is the leader in the weight loss pill, which is the next iteration of this big weight loss craze. So I actually think the upside drivers at Novo are pretty good. And then Lilly's a similar story when you look at the valuation multiple and the EPS growth outlook. I mean, you're at 26 times forward earnings. 5-year average is 36 times. So if you get back to that 5-year average, you're at what? I don't want to do the math in my head right now. You're at 40% multiple expansion. And then you look at the EPS growth outlook for it. It's pretty attractive. Pull up the model. This one's just crazy to me. So they're going to grow earnings at 31% next year, 22% the year after that. So, I mean, probably 60% total. You add in that 40, you're at 100, right? So you're at 100% upside on Lilly. So when I look at Novo, when I look at Lilly, I'm seeing potential for triple-digit upside through multiple expansion, valuation reversion to a 5-year mean, and just the modeled EPS growth rates. I don't see that on UNH because the valuation multiple is already basically back to the 5-year norm, and the EPS growth outlook's not that great, and it's clouded by a DOJ investigation. So because of that, yes, I do subscribe to this. It's 2008 for the healthcare sector, and I think you should be buying healthcare stocks, but be selective. There are better options and there are worse options. And I think the better options are names like Novo, names like Lilly. I think the worse options are probably names like UNH. But having said that, UNH probably will succeed here for, as a rebound play, rising tide lifts all boats type situation.
Got it. So Lilly and Novo Nordisk control about 70 to 80% of that obesity drug market. Do you think there are any other companies that can eat up that market share? Is there a chance for another company that we can see an even bigger edge on, or is it just safer to bet on those two specifically?
Yeah, so the wild horse here, the underdog, is Viking Therapeutics, and their whole pitch is we can deliver the same magnitude of weight loss, about 10 to 15% via the oral pill. In a much shorter time. So when you look at Novo, when you look at Eli Lilly, their weight loss pill clinical results, they're delivering about 10 to 15% weight loss over about 70 weeks. Viking Therapeutics, their oral pill can deliver about 10 to 15% weight loss over, I think it's 13 weeks. So a dramatically shorter time frame. So from that perspective, this is a company that could be a real market share stealer from Eli Lilly and Novo. But that company just hit a massive roadblock in terms of tolerability. So you kind of, like the when you, not to bring up superhero movies again,
Mm.
but it's like the super villains where it's like we always know that scientific progress in drugs is a balancing act between efficacy and safety, right?
Right.
And the super villains always push it to max efficacy without safety, and then there's some massive side effects, and they become some super strong freak, right? Like that's like a classic story in science fiction movies for a villain. It's a classic arc. Well, Viking Therapeutics maybe is that villain. Um, they were able to deliver, I think it was like 13% weight loss in about 13 weeks, which is like unreal, unheard of in this game with their oral pill. But the tolerability side of it was awful. So dropouts were essentially 20% of the people dropped out because of like nausea and throwing up and just general discomfort and not being able to continue the regimen. That's a massive dropout rate. When you look at like Eli Lilly and Novo, you're looking at like 5-6% dropout rates. Typically in this world, anything above 15% is considered pretty unacceptable. So they're up at 20, and dropout rates tend to increase with time. Obviously, like the longer you do a study for, the more people just tend to drop out over time. So the fact that they hit a 20% dropout rate in 13 weeks versus a 70-week study, and those dropout rates were 5 weeks for Eli Lilly and Novo. That's pretty bad. So the company has some massive tolerability challenges because they probably pushed the envelope on titration, on kind of dosing up front and early, and that caused a lot of intolerable outcomes. And so from that perspective, that company, it looked like they could be a major competitor. Maybe not. They can do some things to kind of maybe drag it out, maybe make it a 36-week trial or a 46-week trial and see if that improves tolerability. But it's all on management now to re-engineer the titration and maintenance schedules to see if they can continue to drive double-digit weight loss, but get that dropout rate down into the single digits. And that's going to be tough for Viking management to do. I think maybe they can do it, but it's going to be tough. And until they do, the duopoly of Novo and Eli Lilly is preserved.
Right. Yep. That makes sense. I mean, even if you cut their time span in half or increase it by 2 times, it's still more than half of the length of the Eli Lilly or Novo
And
Nordisk
and
drugs.
and, and that's why the bull thesis on Viking stock dropped like 50% this week on
Yeah.
that data. That's why the bull thesis for them is actually still alive. Because you know what? They were able to deliver like basically 13% weight loss in 13 weeks. Like no one's doing that. Like you
Right.
clearly have some efficacy magic here. And efficacy magic is always that's the big one, right? Like anybody can make a safe drug, but can you make a drug that actually works? So they have a drug that actually works. Now they just have to make it more tolerable. And that is doable. That is manageable. It is hard, kind of like Opendoor. There's a pathway forward, but it's littered with obstacles and it's an uphill battle. So they can do it, but it's going to require some strong execution to get there.
Definitely. Okay. So another one to keep an eye on. Now, I do want to move on to our next topic here. I want to talk about Apple and specifically Apple digging into the robotics sector,
Mm,
essentially trying to dive into the home market and creating an even larger ecosystem than what they have now with the
mhm,
iPad, iPhone, personal computers, branching out into things that go inside of the home, security cameras, and
mhm.
things of that nature. I'd love to get your take on that, Luke.
Yeah, entirely. Apple is a another sleeper, if you will,
Yeah.
in the AI space. They haven't really done much. Apple Intelligence has been a flop. I think they're going to acquire somebody. We've talked about this when we talked about the Apple earnings report. Tim Cook, uh, his language suggested that they are going to acquire somebody. Now I think they may acquire a robotics maker. Like,
Mhm.
I think that's the direction they're going in, and that's a really smart pivot to be making. I think Apple has always been very, very dominant on physical consumer technology and not so dominant on digital consumer technology. Yes, iOS is great, but you're not using. I mean, Apple Music's okay, but it's been dominated by Spotify. Apple
Spotify.
News is okay, but we still use our regular news apps, right? Like they're not really a software heavy hitter. They're a hardware heavy hitter. And so when we're talking about what they can do in AI, they tried to go the software route with Apple Intelligence. I thought it was going to work, but maybe that's just not where their strengths are because Apple Intelligence has been a dud. maybe their strengths are in hardware. Maybe they need to get back to those roots. This appears to be at least a step towards getting back to those roots. Let's make AI hardware. Let's make robots. Let's make home robots. Let's make things in the house that are going to automate the house. I think the smart home idea is massive. I think Apple can really infiltrate that. I think they should get into glasses and things like that. Just ditch the Vision Pro. I think it's a complete, I don't know why they're doing that, but ditch the Vision Pro. But I do think it's really interesting that the OS update, remember they did like what's it called, liquid glass,
Yeah.
where they're changing the entire interface and how it looks on your smartphone for the first time in about 10 years. It's not going to be flat anymore. It's going to be like holographic. Like, come on now. Like that, they're showing you their cards. Everybody plays their cards close to their chest. They're showing you their cards. They are taking the OS from a device that nobody has and nobody uses, the Vision Pro, and they're taking that OS and putting it on a device that everybody has and everybody uses, the iPhone. Why? Like, why are you doing that? You don't take from the worst and give to the best. Typically, you model after the best and try to make, lift the worst up. But they're doing the opposite. They have their worst performing hardware device and they're taking the software OS on that and putting it into their best performing hardware device. They're doing it because they're mentally prepping people to be like, get used to this holographic display because we're going to move towards holographic displays. We're going to move towards glasses. We're going to move towards things that are like Jarvis, right? I think they're prepping people for that. So I think Apple is quietly making very smart moves. The stock has, it's been fine. Hasn't been a major winner. Hasn't been a major loser. It's been fine. I think it'll wake up in a little bit. And I think it'll be a pretty big winner. And I think suppliers to Apple will be a pretty big winner. Corning, GLW, that stock's been on a rip partly because of iPhones, but also other things related to physical AI devices. So I think the whole Apple supply chain could be about to wake up in a pretty major way, kind of like it did in the early 2010s after the launch of the iPhone. And I think the robotics pivot is a big step in the right direction for the company. They're finally doing what I think are the right things to become an AI winner.
Gotcha. Okay, you kind of answered what my follow-up question was going to be. I thought it was interesting that you called it $3.4 trillion market cap company a sleeper. So I wanted to ask what the upside would be with Apple. So we're more or less looking at the suppliers via the supply chain for the robotics versus looking at Apple itself as our kind of upside bullish play.
Yeah, I mean, listen, I'm a big proponent in owning the Mag 7. I don't think why you wouldn't. I think the
Right.
economy is getting narrower. I think the market's getting narrower. I think you got to own the Mag 7. All these skeptics and pundits and critics saying Mag 7 dominance is overdone. You got to sell those stocks. It's the most crowded trade in the world. Okay, it's the most crowded trade in the world because it's the best trade in the world. Okay. Like, the most crowded bar in the world is probably the best bar in the world. The most crowded movie in the world is probably because it's the best movie in the world. The most crowded restaurant is probably because it's the best restaurant in the world. The Mag 7 is the most crowded trade in the world because it's the best trade in the world. And it's where all the revenue growth is. That's where all the profit margin expansion is. That's where all the profit growth is. That's where all the innovation is happening. So I'm a big proponent of owning the Mag 7. I don't think you shouldn't own the Mag 7.
Of course.
But yes, if you're looking for that extra juice, that extra kick, that's going to come from the supply chain for the Mag 7. So if we're talking about Apple making a potentially big positive move in AI, that'll be reflected in Apple stock price. It goes up 20% in a year. Woo-hoo. But the Apple supply chain is what will move. And will move 100% or 150% or 200%. And that is true for all the Mag 7. So one of the best ways to kind of play AI really is to have the Mag 7 and then understand the Mag 7 supply chains. And when you're feeling really confident about one of the Mag 7 making a big move, then you kind of go in with their supply chain.
Got it. Yeah, I mean, sounds like a great play. Okay. Now, do want to move on to our exponential or breakout stock section, Luke. We got 5 again this week. We want to pick it up with TEM or Tempest AI.
Tempest AI, healthcare AI, not 2008 moment for them because they made the scan this week. As you can see, the stock is in a breakout mode. I'm pulling up a chart right now. Nice breakout for the stock. I really like this one fundamentally. They're using AI to create personalized healthcare treatments. They're partnering with hospitals and healthcare providers. They're taking their AI engines, combining it with healthcare provider data, and creating personalized treatment plans for people. This is the future of medicine. The stock, in my opinion, is a fantastic long-term play on healthcare AI. And right now it's waking up in a very positive way. You can see that it's bouncing higher off that 200-day moving average, really spiking. It's cleared a lot of major resistance levels. I don't think it stops. You can, hold up, give me, oopsies. Boom. So we cleared that peak back here from August 24 around 71, cleared it. Okay. We just temporarily cleared this peak from November of 24 around 78. We barely popped above it at 78.45. Now we're below it, but I think we're going to bounce back above it. I don't think this one rests until we get to the major peak, which is not that, this one. And that's right around $90. So I think temp is short term 90. That's a good target. Medium longer term, I think it's just a great long term play, something you want to own if you're bullish on AI, especially AI's ability to unlock better patient outcomes in healthcare. They're powering that.
Awesome. Yeah, and I mean AI with AI, right?
AI with AI, brother.
All right. Next up, we got OUST or Ouster.
LiDAR provider, sensor player, waking up because self-driving cars are becoming a thing again, waking up because you need LiDAR maybe in humanoid robots. As you can see, this is one of those stocks that, one of those SPAC boys. Did the SPAC in 2020, big gains, choppy around, massive stage 4 decline in 2022, stage 1 consolidation throughout 23 and 24, and now waking up here in 25. Fundamentally, I'm not terribly in love with it. I think there are better LiDAR suppliers out there. We talked about Hesai. But, Wall Street, or at least somebody, clearly likes this stock. The chart looks beautiful to me. Again, fundamentally, not a huge fan, but this chart is gorgeous. This is a textbook massive stage 4 decline, boom, stage 1 consolidation, and now into a stage 2 breakout. It's just a textbook stage 2 breakout. And because the stage 4 decline was so enormous, the stage 2 breakout could be equally enormous. Does that mean we retake, the SPAC level of $100? Maybe, probably not, but maybe. But I can see why traders are piling into this one. Again, fundamentally not in love with it, but if you're a trader and you look at charts and you're trading off technicals, there's a lot to like about this one. I think based on technical momentum, it can go higher.
Roger that. Okay. Next up, we got Brilliant Earth Group, BRLT.
BRLT, diamond company, really known for lab created diamonds. They just had good earnings. You can see this stock has been decimated because, well, you know what? People aren't getting married right now.
Yeah.
Um, uh, the whole generation of people, I mean, they feel like they're slaving away. They barely have enough money to cover the cost of living. They're not buying homes. They're not having kids. They're not getting married. They're just pushing back all those big life decisions. So a company like Brilliant Earth, who sells diamonds to those people, they specifically sell it to younger audiences. They've been crushed, reasonably so. Demand has been crushed, revenue has been crushed, but strong earnings report recently shows maybe there's some sign of life here. I think this one, it's too early to say it's a turnaround, but I do think a turnaround is coming to Brilliant Earth. I'm optimistic on the idea that interest rates are going to fall. Affordability for a lot of things, cars, homes is going to improve. You're going to get a refi boom. I think a lot of people that were at mortgages in the last 2 years, around 7%, are going to be able to refi lower over the next 2 years, maybe 5, 4%. That's going to be extra capital that gets unlocked. I think people are just going to get kind of tired of waiting, and they're going to go out and they're going to get married. They're going to go out and they're going to have kids. And I just think that you're going to get a reawakening of that part of the economy over the next 24 months. And if you do, then Brilliant Earth will have a massive comeback. But as of right now, this is just a very short-term pop and a massive long-term decline. It's too early to say that it's the beginning of a big turnaround. But again, I see a pathway littered with obstacles, but a pathway towards potentially massive returns for Brilliant Earth from these massively depressed levels.
Just a quick aside here. I think Cristiano Ronaldo, one of the biggest football players on the earth, just recently proposed to his girlfriend, something along those lines. But he had the reportedly most expensive ring ever made. So it's just kind of funny to see the chasm divide in terms of, even things like jewelry versus, jobs. Most expensive ring ever, and then general ring sales declining.
The bifurcation, man. The bifurcation.
Yeah, happening everywhere.
It's just it's yeah, man. I don't know. I'm not gonna say go research the French Revolution, but I don't think it would hurt.
Right,
The, the,
right, right.
the economy's so bifurcated, the market's so bifurcated, and the concentration's only going to get heavier. It's only going to get more top heavy, I think, in both instances. It can't last forever, but I mean, it will last for now, and we'll see how bad it gets. But yeah, that is life. That is life right now.
That's life. All right. On to the next one. We got real. Ticker symbol real.
Yeah. This is kind of like along the line. Remember we talked about ThreadUp, right? Was that last
Yeah,
week
yeah.
or 2 weeks ago? Yeah, I mean similar story. Kind of like okay, all these tariffs are causing prices on new shit to go up, so let's go buy some old shit. Let's go buy some used shit. That's basically I don't mean to be crude, but that's basically the bull thesis here. New shit's getting more expensive, so let's buy old shit. Real has been on a tear ever since. Well, really. Since early 24, but as you can see, kind of when the tariffs got announced, this one had a pretty big moment, and it's maintained its uptrend. The thing I like about this one is again massive stage 4 decline throughout 21 and 22, big stage 1 basing pattern throughout 23 and 24, and then you have this breakout in 25. It kind of came down to levels double bottom, triple bottom, quadruple bottom, multiple bottoms here, right around that $5 level, and then boom, blasted higher, retook the 50, retook the 100, retook the 200, making new highs, clear breakout. This is an uptrend that will persist, in my opinion. And I think we'll retake a lot of these levels back in 21, right? So I think this is one that could go to 20 or something like that. Like I like this story. I think it makes a lot of sense. And I also like the chart. So if the story looks good and the chart looks good, probably a good stock.
I can't argue with that, Luke. And then last but not least, we got solid power.
Yes, I think we've talked about SLDP before. We've definitely
Correct.
talked about QuantumScape before. Solid state battery makers are making a comeback because it's becoming apparent to Wall Street that you need these for more than electric vehicles.
Mm.
These are going to be essential to robots, whether it's a humanoid robot or a warehouse robot or any sort of robotic dog, any sort of robot is going to require batteries. And lithium ion batteries, obviously, the choice for now. But if we can get to solid state batteries, a breakthrough there would be a breakthrough not just in EVs, but also in humanoid robots. So you are getting rallies in the solid state battery stocks, QuantumScape, Solid Power, etc., on addressable market expansion. Not on execution, really. Not on the fact that we're so much closer to solid state batteries now. No, you're getting these rallies because the potential upside, if and when we do get to solid state batteries, has been multiplied because of their potential applications in humanoid robots. Um, that's not great. That doesn't feel like a super sustainable rally, but you know what? I think solid state batteries are going to be a thing within the next 3 to 4 years, and I do think they are going to have huge applications in robots. And I think that these stocks were completely unfairly and overly punished because of the electric vehicle kind of meltdown that happened in 23 and 24. So from that perspective, I think these early stage rallies, early stage comeback rallies in names like QuantumScape and Solid Power, et cetera, They feel legitimate to me. Now, not all of these companies are going to win. I think in the long term, 10 years down the road, only one of them is going to be left standing, and that's probably going to be QuantumScape. But that doesn't matter in the short term. In the short term, kind of like with quantum, I think in 10 years, the only one left standing may be IonQ. I'm not sure quantum computing is going to be around, the company QUBT. I'm not sure that D-Wave is going to be around. I'm not sure Rigetti is going to be around. But all those stocks are rising in tandem. So when you have like an early stage technological breakthrough that starts to gain momentum or regain momentum in the case of solid state batteries, rising tide lifts all boats. All of the stocks go up at once. Then there's a filtering and a consolidation mechanisms that come into play later down the road, and then you get your one winner and your four or five losers. But we're far away from that, both in terms of quantum and in terms of solid state batteries. So because of that, while I do think that IonQ is going to be probably the one and only winner in quantum, and I think that QuantumScape is going to be the one and only winner in solid state batteries, I think their partners, their competitors, the companies around them in the same space will succeed alongside them in terms of stock price appreciation over the next several quarters. So that's my outlook on SLDP.
Got it. Yeah, I think the solid state battery into robotics bull thesis is really interesting because if we take Elon Musk, for example, saying with Optimus, Tesla will be at a $25 trillion market cap, that's multi-trillion dollars in a TAM, right? For whoever takes ownership of the solid state battery.
Well, the really ridiculous thing is when you hear somebody talk about robots and they talk about the productivity unlock that robots will have. People are always like, robots, they don't need vacation, they don't need paid time off, they don't even sleep, they just work all the time. You know what? They do sleep. It's when their batteries run out. Okay?
Right.
When a robot's battery runs out, it needs to go recharge. And if you own an electric vehicle, you are intimately, painfully aware of how long it can take lithium ion batteries to recharge. Right? You will be sitting there. You'll have driven 200 miles, 250 miles. You'll be sitting at some random charging station for 30 minutes, just wasting time. Like, it
Mhm.
just takes forever to charge. Like, why? It's like, could you imagine if humanoid robots have to do that? Like, we're not going to be able to buy enough to where I can just swap one in while mine's charging, right? It's like, you can't have that downtime. All of a sudden, the productivity unlock that everybody talks about for the robots, it gets short circuited by batteries that suck. So we need batteries that don't suck. And that's why solid state battery, the bull thesis for application to robotics, it's really compelling because the whole entire thing about robots is the productivity unlock of them. If they weren't more productive, why have them? Right? Like there's no reason to have a robot unless it's more productive, unless it's cheaper to use. So the whole bull thesis behind them kind of rests on us making better batteries. And that's why I think these names will continue to get a pretty big bid, so long as that robotics wave continues to happen. Which it will. Did you catch the World Humanoid Robotic Games this past weekend?
I did not. I think I'll have to go check that out.
They happen off in China. That company that we've talked about here, Unitree, they're making that. They have the R1 robot that's retailing for about $5,000. They took home 11 golds. It's pretty cool. People should go YouTube and watch it. It's a pretty. I mean, they're not great. Again, it's not Ronaldo playing soccer. It's not
Yeah.
Usain Bolt off the starting blocks getting the sub 10 100-meter, but it is a very impressive demonstration of how far we've come from robotics and how much these machines are able to do and the exponential progress that they are currently experiencing. So from that perspective, I think it's worth a watch, and it's a feat to the fact that the robots have arrived, they're getting better, and they're going to proliferate rapidly over the next several years.
Without a doubt. Yeah, definitely put it in my YouTube search bar. I'm gonna check that out after this episode. And now just to round off the episode, just want to make sure people know about uh, asking questions or making it a community. We did get a question from Doris from Florida. She was curious about RWD and Fiverr. I like the idea of Fiverr, the essentially marketplace for freelance workers. I wonder how that's faring in terms of job growth itself going down.
What was the first one? Was RWD?
RWD, that's Reward Minerals.
Yeah, I'm not seeing a RWD here. Maybe she meant RDW.
I don't know, but we do have
Anyways,
five.
let's talk about Fiverr. I think Fiverr is an interesting story. I think Fiverr is a really interesting story. Um, I've been saying this is a market that you want to cut your losers and stick with your winners. But Fiverr is there are objections to every rule. And Fiverr is going to be an objection for me to that rule. This has been a loser. Look at the stock chart. It's not pretty. Kind of stuck in neutral, not going anywhere at the bottom side of its trading range over the last year, more or less. Below the 200-day moving average, not a pretty chart. You look at this chart, you're like, that's not an AI stock. That's an ugly stock. Okay, fair enough. I get it. If it were any other stock and I didn't intimately know the fundamental story, I would say, yeah, get rid of it, cut your losers. But I think Fiverr has a really good story. The story here is that there is there are so many AI tools out there. Whether we're talking entry level LLMs like ChatGPT or more complex software from AI software from Palantir or whatever, there's so much out there. How do you use it? like, how do, an AI tool itself? I have ChatGPT on my computer. My mom has ChatGPT on her computer. She doesn't know how to extract value from it. Like she's still calling me all the time.
Hmm.
Like, how do I use AI to do this? How can I help it plan my trip to here? How can I help it craft a diet for me and dad? Like she's still calling me all the time to figure out how to make use of an AI she has seamless, infinite access to. That's the Fiverr value prop. The Fiverr value prop is that there are all of these AI tools out there to which people and companies have access. Yet there is a gap between AI tool access and extracting value from those tools. How do I actually use them to do whatever you want to do? Make more money, cut costs, automate this, automate that. Fiverr can fill that gap with AI experts. Fiverr can leverage a team of human AI experts to fill the gap between AI access and AI action. And I think that gap is pretty large right now. I think it's pretty huge. When I go and I talk to people about how they're using AI, what they're using it for, they're clueless. Most people out there right now, no offense to most people out there right now, but they're just clueless about how to use AI really effectively. I mean, it took me a while. I play with it every single day, and I have been for the past year plus. And only now do I feel like I really got a hang of it and like how to do it. A lot of people don't have time; they don't really care about it, and so they need to fill that gap between AI access and AI action. And I think Fiverr fills that gap very, very nicely. So, from that perspective, I think this company does have a long-term bull thesis. I do think the growth narrative here is still pretty healthy. The stock is beaten up technically, and the valuation, I mean, hold up. Oh, I got too many tabs open. Let's go to one of these other ones. We're talking about Eli Lilly. Let's look at the Fiverr. I mean, the growth profile to me is solid. There's nothing in these numbers that looks bad to me. Revenue growth going to be about 11% this year, 8% next year, 10% the year after that. So we're talking 10% revenue grower. Gross margins, that's a high margin business, 84%, 85%, 85%. EBITDA margins, nice expansion, 20%, 22, 24. EPS growth, 10%, 5%, 13%, 12%. So this is a double digit revenue grower and a double digit profit grower. And it's trading at a high margin, low capex, double digit profit grower, trading at 5.6 times EBITDA, 9.7 times forward earnings. Those multiples are reserved for companies that are going out of business. And I get it. There is a thesis out there that Fiverr is going out of business, but I don't believe it. I don't buy it. And because I don't buy it, when I see a 5 times EBITDA multiple on the stock that is still projected to grow earnings at double digits over the next several years, this is the exception to the rule. Cut your losers, ride your winners. Unless you have contrarian opportunities like this that look pretty compelling. That's where I'm at with Fiverr.
Yeah, I did think it was an interesting question because it does feel like the job market is going to be expanding into just a larger gig economy overall versus, specialized roles for anything. So yeah, where did
No,
Fiverr place?
that's an entirely another great vertical to the story, angle to the story is that, even if, LLMs do a lot of stuff that Fiverr can do, okay, great. But the whole entire gig economy is probably going to expand because you're going to get a lot of, well, firing at big corporations that are
Mhm.
using AI. And now you have a lot of just freelancers and a lot of just what I call AI bootstrapping. You're going to have a lot of AI bootstrapping. And I think Fiverr can be a hub, a marketplace for a lot of that AI bootstrapping. So that's an excellent point. I thought of that previously, didn't think to bring it up here, but thank you for that is a great point as to one of the reasons why this sell off in Fiverr stock is overdone, in my opinion.
For sure. All right, that wraps it up for that question. And again, please like, comment, and subscribe, obviously, but definitely comment. We want to make this a conversation for sure, and just expand the Being Exponential community. But with that, Luke, is there anything you think we might have missed this week that you wanted to talk about?
No, I think we covered a lot of ground. It's kind of a quiet week on Wall Street because we're in
Sure.
between some major catalysts. We got the bulk of the earnings reports are over. The next big one's not Nvidia to the end of the month. There's not really a lot going on right now, so it's kind of a quiet time. But a lot of very interesting things are happening beneath the hood. And I think paying attention to those is what's going to allow you to find tactical buying opportunities amidst this chop on Wall Street. Because the chop will end, this market rally will resume, the AI boom will live on. It won't last forever, but I think the next 12 months it will last, and I think it could be the best 12 months yet. So let's find tactical buying opportunities amidst chop while this AI boom continues to live and breathe.
Got it. You didn't want to talk about Target's earnings?
I love Target, man. I don't know. So I can't find them anywhere else. Maybe Staples has them, but these Pilot G2 pens, but 1.0. I like the thick.
Yeah.
I don't like the little. Some people buy the 0.7s, and I can't do it. I like it. I don't
Zero
know.
point 0.7 right here. I love it.
Uh-uh. No, I'm 1.0 all the way. I would write in Sharpie if I could. I would write in Sharpie if I could, but the problem with Sharpie is it bleeds through pages, and I write in notebooks, and bleeding
Got it.
would cause the pages to be ruined. So in any event, I like Target for their 1.0 G2 pens.
Cool. Good
Not
stuff.
their
All right.
earnings. Not their earnings.
All right. That wraps up another week of Being Exponential with Luke Lango. We hope you've enjoyed it. We definitely have. And we look forward to seeing you next week. Take care.